Welcome to The Explainer. Today, we're diving into a real clash of the titans in the Indian IT world, Tata Consultancy Services versus Infosys. The big question is, which one is the smarter bet for an investor? Well, let's find out. We're going to be breaking down a fantastic deep dive study from Stressfree Investing. They've really gone through these two companies with a fine-tooth comb to figure out which one comes out on top. All right, let's get right into it. But you know what? We're going to do this a little backwards today. We're actually going to start with the final results. So here it is, the final scorecard from the report. TCS gets a seriously impressive 86 out of 100, and Infosys comes in with a really strong 81. Now, both of these are A-grade companies for sure, but the report does declare a clear winner. And that, right there, is the core of our whole explainer today. I mean, it was a close race. So what was it that gave TCS the edge? Let's unpack the analysis, round by round, and really see the story behind these numbers. First up, let's look at the engine room of any great business, its profitability. In other words, how good are these companies at turning their capital into actual profit? The report really hones in on one specific metric that it considers, well, pretty much the most important for judging the quality of a business. And that metric is ROCE. So ROCE, that's return on capital employed, is a really simple but incredibly powerful idea. It basically asks, for every single dollar you put into the business, how much profit does that dollar spit out? It's really the ultimate measure of efficiency. And wow, this chart just lays out the fundamental difference between these two. TCS has a jaw-dropping 65% ROCE. That means for every dollar of capital, it's making 65 cents in profit. Now, Infosys is great at 37.5%, but TCS is just playing in a totally different league. And just so you know, this profitability gap isn't a one-off thing. You look across the board, from profit margins to return on equity, and you see the same story again and again. TCS is just consistently more efficient with its capital. Okay, next up, round two, the value bet. And this is where the analysis gets really, really interesting. Because you'd think since TCS is clearly a higher quality business, you'd have to pay more for it, right? Well, not necessarily. I mean, just look at this. Their price-to-earnings ratios are almost identical. They're both trading at around 18 times their earnings. It's one of those rare situations where you can actually buy the better company for basically the same price. But hey, value isn't just about the price you pay to get in. It's also about what the company gives back to you, the owner. And on that front, the report shows a pretty big difference. TCS offers a dividend yield of about 5.5%. That's way higher than Infosys's 3.3%. And that's because TCS has this policy of returning almost all its profits back to shareholders, which creates a really nice income stream for investors. All right, now we come to what the report calls the decisive advantage. This is the one factor that truly pulls these two companies apart. And it all comes down to this really simple balance of risk and reward. It's not just about how much you could make if you're right, it's also about how much you stand to lose if you happen to be wrong. Okay, this slide right here, this is the real aha moment of the whole analysis. The report calculates something called an asymmetry ratio. For Infosys, the potential upside is about 3 times the potential downside. Pretty good. But for TCS, it's a mind-boggling 14 times. That is just an incredible risk-reward setup. So the big question is why? Why is the downside for TCS so much more protected? Well, the report puts it plainly. TCS is sitting on a massive fortress of cash, and it has that high dividend yield. Together, they act like a natural floor under the stock price, cushioning it from big drops. And this safety net, it's really built on 4 huge pillars. You've got a massive, stable stake held by Tata Sons, which means stability. It has a wider competitive moat, so it's harder for clients to just up and leave. Then there's that enormous cash reserve we talked about. And finally, a super shareholder-friendly policy of returning almost every single rupee of profit. So it's time for the final verdict and outlook. Let's bring all these pieces together and see what investors should probably be keeping an eye on going forward. The case that the report makes is just so methodical. Step 1, you've got superior profitability, driven by that insane 65% ROCE. Step 2, you've got better value. You're paying the same price but getting a much higher dividend. Step 3, an unmatched risk-reward profile. And finally, step 4, it's all held up by a balance sheet that's basically a fortress.
Of course, no investment is ever a set it and forget it kind of thing. The report points out a few key things to watch. For TCS, investors should be looking for a return to quarter-on-quarter revenue growth, making sure those big deal wins keep coming and keeping an eye on its debtor days.
And all of this leaves us with one final and really crucial question. The analysis today clearly crowns TCS as a fortress of stability and quality. But we are all entering an age of just unprecedented change, all driven by AI. So the biggest unknown is whether the very walls of this fortress can hold up against the disruptive winds of innovation that could literally reshape this entire industry. And that is a story that only time will tell.